Hey, welcome back to the show. Total Financial Solutions, Safer Money Hour. Hey, I'm Arif Halaby. That's Jeff Gerard on your place for news, talk, and information. AM 1220 KHTS, Total Financial Solutions, Safer Money Hour. Okay, look, there's reasons that people don't buy life insurance. We understand that. And sometimes the reasons are simple. It's because it doesn't benefit themselves, right? They're saying, this is for other people. It's after I pass away. My wife and her new boyfriend, or my husband's new girlfriend. We've heard them all. And yes, it's a little lighthearted and even funny. But I think you got to realize that today's life insurance policies, and look, frankly, for quite some time, but they give you benefits that you can use while you're still alive. And I want to touch on those a little bit, just so you have a feeling of what they are and you understand. Because part of what happens is to know that you and your family can still benefit from the life insurance policies that you buy.
Well, yeah, and I think that helps take away some of the argument of the value of the policy, not having to wait until you pass away. Because if I say, wow, you were talking about how yucky it is, Arif, earlier in the show, to pay for something that you are never going to use. I mean, that's kind of yucky. Now, look, car insurance, we need it. We like it if we use it, if we need it to fill a gap. But if we never use it, it's kind of yucky. Life insurance falls down that same path in a lot of respects in people's minds because they say, I will never see the benefit of this. Once I pay it, it goes away. And if I don't die, then they don't pay. But if I die, I don't see it anyway. Some companies out there have revolutionized, and it's been, like Arif said, for some time, revolutionized that thought by saying, we're going to offer the policyholder something called a living benefit. Now, what does that mean to you? That means that you pay your premium just as you normally would for a life insurance policy. You die, they pay. The money still goes under current law, tax-free to your beneficiaries. Whoever you say is to receive that money, that's the way it is. It's a unilateral contract.
And the benefits to a life insurance policy for you and your family are pretty simple. Even while you're alive, if you have a terminal illness, a lot of people, when they have an illness that's pretty serious and it's terminal, they have to quit their job. Maybe one or both spouses have to quit their job, and they run out of money very quickly. They go into financial problems, whether it be losing their home or just trying to pay and stay afloat financially. Life insurance policies, many of them have a 25% or 50%, meaning up to half of the amount that's the face amount. Meaning you have a $500,000 policy, you're allowed to pull out $250,000 in cash, pay your bills, pay for treatment, pay co-pays. Goodness, under the current Obamacare thing, your deductibles have gone through the roof.
Right.
Some people can't afford it, right? They just shifted it. Well, now your credit cards are going to be maxed out because you have to live. So things like that could be paid for ahead of time. And not only that, Jeff, but nursing home care and terminal illness. There are plans that go through just assisted living. Maybe you need a little help getting around. Maybe you've had this policy for 15 or 20 years, and now it's time that you need to take a little bit out to pay for your benefits. Bring somebody into your home, help cook and clean. So there's all sorts of ways to assist you financially with your life insurance policy. We've seen that as well, Jeff.
That's right. And truth told, you don't want to qualify for that accelerated death benefit is what it's called, because that means that you're pretty close to expiring. You've got some real health problems, terminally ill. Sadly, people don't every day turn around from that. So if you're accelerating the benefit in that manner, a lot of policies offer that provision where they say, look, if you have 12 months to live and that's been, deemed by a medical doctor, we'll go ahead and we'll give you, in Arif's example, 25% or 50% of whatever we would have given you at your death. We can give that to you now while you're alive so that you can have a better, more comfort or better care or whatever have you while you're still alive.
And we've actually had a client who used it, and it was a little weird, but this is what he did. It was his money, and he took it, bought a new car for himself, bought a car for his wife, paid off all the bills, and threw a party in the neighborhood, shut down the street, got the city permits, brought in a carnival and jumpers for the kids, because he had no children at the time, but young families and nieces and nephews that were his, and then other kids in the neighborhood.
Yeah.
Brought in a barbecue and really did it up, Well, that was 20 years ago, and he's still alive today.
That's fantastic.
So sometimes, and he used some of it to pay for his coverage down at UCLA and Cal State Northridge and the different hospitals that he was being treated at. But the point is, 20 years ago, he was able to take out money and live. because sometimes that's what happens. You're just saying, I just want to take that trip. I just want to do that bucket list.
That's right.
So there's a provision that allows that. Not always the greatest, but it can happen.
Or it could help afford you some, maybe some newly found treatment that's out there that's not affordable under your current plan with your health coverage, if you have any at all. So sometimes that can be the most life-changing part of that provision, that they're going to accelerate and give you that death benefit up front. The other part is, and that's been around for some time with most policies. You're going to see that as a standard provision in a lot of policies out there. And we're talking about the term insurance. Now, there's something called permanent insurance, where it still says, hey, if you pay the premiums, and if you die, we'll pay your family. But the living benefits that go beyond that terminal illness could be something like a chronic illness in some cases. It could be a critical illness. It's not always the 85-year-old person that, broke a hip and fell down and they can't move around anymore. Sometimes it's someone in their 40s or 50s who got into a really bad car accident, and they have to have now a long-term care scenario. That's the misnomer is that's just for old people. Well, define old, number one. Because it depends on what day
you
of the
guys
week.
Remember Christopher Reeve, right? He fell off a horse, and thankfully he had the right kind of insurance, and that's what helped them not go bankrupt.
That could be someone like that. Absolutely.
It's not a difficult thing to think about. We've had a friend whose daughter was recently in a big car accident. I think over here on Soledad, and a big pipe came through and hurt a lot of them in the car. But one of them is, had to rehab and come back from a very serious, debilitating injury. Sometimes it's things like that. Sometimes it's a stroke. We had somebody in our client base who had a stroke and had to start all over again. Other people, if you're older and you fall down, like Jeff was saying, you break a hip, that can be pretty serious. It used to be a death sentence. Right. If you were a senior and you broke a hip, you went into a hospital, next phase was pneumonia, next phase was see you later.
Right.
But in this particular scenario, a lot of people with the right amount of care and the right help, the right family, the right knowledge, can come back from those things. And this type of a policy, where it has living benefits, can really make a difference. If it's a permanent plan, it just means it's going to last till age 105, 110, 114. We've seen them where they go on. It just depends. Each is a little different. But you can buy it where it lasts for that entire time. Some of them, you'll pay more money for it now. You'll pay a higher rate, but it never goes up. It becomes the new rate from now until you pass away. So for some people that think they're going to need insurance for much later on in life, there's a great reason to have it. Then there you go. But Jeff, tell us about the return of premium option, because that's something that not a lot of policies have, and it's unique to life insurance versus something like car or homeowners insurance.
That's right. And return of premium insurance, if you were to look at it, let's just call it a term policy, okay? A term insurance where it's pure insurance. You die, they pay. If you don't die, you don't pay. They covered you for a period of time, and they said that we're going to give you X amount of coverage, and you're going to pay us X amount per month or per quarter or per year. Well, some policies have a feature where they say, look, you pay us a little bit more in that term scenario, in that term life insurance, and if you pay for 10 or 20 or sometimes in some cases 30 years and you don't pass away, we are going to refund you all of the premiums that you paid us. And in some cases that's tens of thousands of dollars that you could get a check back from the company because they covered you but they didn't have to pay a claim.
So you'll pay a little bit more during the term. Remember, the term is, let's say, 10 years or 15 years or 20 years, whatever, that period of time. So you'll pay more than you would if it's just pure insurance. But if you didn't die during that time, all of the premium payments that you paid come back to you. And because it's $1 coming back to you, if it's more than you paid, then you'll pay, or at least it's subject to, income tax. But if it's less than it or the same, which is usually the case, it's the same, then there's no extra income tax and you were covered for free, if you will, for that period of time.
Sure.
That is helpful if you're trying to say, listen, I don't know if I'm going to die. I have longevity in my family, but people don't know if they get hit by a bus or all sorts of things happen. There's a way to kind of protect your family.
Well, and especially if you're buying it, relatively young, maybe in your 20s or 30s, and you do have that longevity, and you don't anticipate, like we said in the beginning of the show, you don't anticipate dying before you're 60. This is one of the ways to kind of build in a savings plan, if you will, into this coverage scenario, and you still are able to take something tangible away from it versus, hey, they covered me and I didn't die. Whew, okay, but you just pay, you had a pretty long-term expense there.
And life insurance has a provision. It's usually 2 years in California and in the United States. It's called a contestability. That means that in those first 2 years, if you pass away, let's say you do your medical test, they do everything, you're fine. A year and a half later, you pass away and you die from a heart attack. People say, oh, wait a second. What do you mean? You were perfectly healthy a year and a half ago. The company has the right to go in and research whether or not you lied on your application or you hid some medical procedures or doctor treatment. Now, if we had one person that had terminal cancer and died within 2 years, they didn't know that. Well, the company does their investigations, the insurance company. They find person told the truth. Everybody answered appropriately. Right. It was just something that wasn't caught. Perfect. They were paid out.
Or in the case of a 34-year-old client that disclosed everything, thought he was healthy from his perspective. The company did their diligence, and within, I think, 18 months or 14 months, something like that, boom, dies of a heart attack, unexpected.
Yeah, I remember that.
And they paid the claim. They said, hey, we couldn't find anything wrong at the time we did the underwriting. So, everybody, not everybody, but a good majority of people think, oh, those insurance companies, they rule the world. And, well, they do. They control a majority of, managing the risk out there of people's lives, people crashing cars, houses burning down. We want them on our side. We want them to be profitable. We want them to be able to stay in business so that they can pay out these claims when it comes time. And I guess if you don't know anybody that's ever had a claim paid or known someone that received a death benefit check, it's kind of hard to make that a tangible thing in your life. But we see it in our industry, and we share these stories with you because these are real life scenarios where people are made whole by insurance companies. So we do want them on our side.
Yeah. Do you remember the time we had Jeff, a gentleman who was in his 40s and he died of cancer, and his wife was alive with 4 children under the age of 20. There might have been 1 or 2 adults in there, but under the age of 20 were 4 of them. And it was $1 million tax-free. Now,
life-changing.
All of us would love to have our loved ones back. Forget it. Take all my money. Take everything. I understand that.
Yep.
But when that's not possible, when they are gone, those dollars that come in can make life a little bit easier. Can you imagine if you have a teenager right on the edge of becoming an adult? Sometimes they start acting a little weird, right? All of us were those teenage years. And now dad has passed away. Mom has passed away. Oh, wait, she didn't? She's not there. Why? She's working 3 jobs.
Right.
Just to make the same amount of money that dad was making. And the house, maybe they can't afford to keep the house. So the kids lose dad because he's passed away, mom because she's just not there anymore and stressed out and crying and sad, and the house because they just can't afford it. So what this does is it gives the right answer to keep you from losing everything. And it just makes life a little bit easier, one less thing to worry about. It is never going to replace the person who passed away. We know that. But the greatest gift that I have when I have to deliver a death claim is handing that to people when they say, at least I have this. And I don't know what it is. Maybe we have more school teachers than not, but it seems like 3 years ago, the same thing. She had 3 daughters. School teacher, husband was an engineer. He passed away. She was in her late 40s. And when he passed away, of course, he was earning a lot more money than her. And now she has to decide, what do I do with my income? What do I do with my life? Those are very difficult decisions. But in their case, I think it was maybe $350,000 in life insurance that came in. Think of it this way. If the surviving spouse doesn't have a house payment anymore, then life is really good. But I want to encourage you to avoid what we call mortgage insurance. We in the industry call mortgage insurance. Why do I think that that's a big problem? We come back. I'm going to cover that at the top of the hour as we finish up the rest of this program. But stay tuned. Come back on Facebook Live. We see you guys. Thanks for watching. We have mortgage insurance because I want to give you a little bit of a trick in the industry. And I think there's a way to achieve what you think you're achieving, but without the risk and the cost of the mortgage insurance. We'll come right back. Stay tuned in about 3 minutes on AM 1220 KHTS. I'm Arif Halaby. That's Jeff Gerard on AM 1220 KHTS. Hey, welcome back to the show, Total Financial Solutions, Safer Money Hour. Arif Halaby and Jeff Gerard on your place for news, talk, and information. Okay, your family's finances when it comes to the mortgage insurance, because once you buy a house or you refinance your house, your information goes out to the public. In other words, everybody goes, hey, this person just refinanced their house. They have a mortgage of X amount of dollars. We're going to give them insurance. And they send you these little cards in the mail. If you've seen them, you get tons of them because that list is a free list. It's well, not free, but people buy it, but it's a public list and it goes out. Here's what mortgage insurance is. It acts just like a regular life insurance policy in the sense that if you die, they just pay off your mortgage. But let's say you have a $400,000 mortgage. Well, if you pass away, they're going to pay off $400,000. So you pay the same amount, let's say $50 a month, and you're going to always pay $50 a month for the next 30 years. But what happens to the mortgage? What happens to the balance of the $400,000 mortgage every year?
It goes down.
That's right.
Yeah, you pay it down. But
So,
you're still paying
the same amount.
the same amount.
So if you need $400,000 in life insurance, just go direct and buy $400,000.
Yeah.
And if you die, and now today the mortgage is only worth $300,000 because you've been paying it down for 6 years or 8 years or 9 years, great. You get to keep the difference. And you don't have to pay off the house. Let's say you decide we're going to keep that house and I need the cash to relocate, or I need the money to do other things financially speaking. Well, then if you own regular life insurance, you're not forced to pay off the house. If it's mortgage insurance, it goes and pays the lender. You get the deed. Wonderful. But what if you needed the money? What if you preferred to do other things?
And what if your house is worth half of what they just paid off?
We had that, and you say, well, wait a second. There's programs, right? The whole TARP or the home affordable programs that they were doing where they were reducing payments and spreading them out over 40 years and doing all of that. I don't want you to be forced to make a decision. You can pay off the house if you want. With mortgage insurance, the choice is out of your hand and goes into the hands of the lender and the insurance company, and it leaves yours. So that's why I'm a little bit gun shy about them. Will it pay off the house? Yes, it will. But just don't think that it's real life insurance, meaning you bought $400, it's always going to be $400. That's not the way it goes. It's a declining amount. And as you're still paying the same amount, but the life insurance death benefit reduces.
And that's a great point, because when you look at the cost that they assess that off of initially, in your example of $400,000, let's just say, and I'm going to be a little bit high on this, but let's say it's $50 a month. You're going to pay $50 a month all up until the end. Yeah. And if you had one payment left and you owed, a few $1,000s on your mortgage, or not in that case, but a few $100s, and you paid $50, then
that's right.
You paid $50 a month for all these years, for 30 years, and then when you die, we're going to pay off the house. There was $2,000 left or $100 left.
That's right.
You could have paid it off yourself, for crying out loud.
Yeah, that's right. And the payment is the same, but I want you to get that $400,000. Do with it as you choose. If you decided to get it, put it in your bank, pay off the house, it's still a tax-free transaction.
That's right.
Because it's life insurance.
That's right.
There's a sweet spot, Jeff, to buy, life insurance, and we're processing it and we're going through and we say, when is the sweet spot? When is the right time to buy life insurance?
We're seeing it's right around your 30s or your 40s. That's when you're making moves financially in your career. Your family's probably growing. Look, your 30s, your mid-30s, just before your 40s, that's probably the largest house you're ever going to buy, which means it's probably one of the larger mortgages you'll ever have. It's probably the most amount of kids you're going to have and the most liability you're going to have with your family. That's about the time to buy it as you're starting to ramp that up. If you can get it earlier, great. But if you can get it in your 30s or 40s, that's where we're seeing people buy it the most.
And if you see that your family has medical issues that usually kick in their 30s, 40s, or 50s, get it a little earlier before you have any of the issues, whether it be high cholesterol, whether it be some sort of a rare blood disease, or every once in a while our family gets this. The boys in our family, the women in our family. If that's the case, when you lock it in, the insurance company can never cancel you. It doesn't matter if you have HIV the next year or cancer the next year. That doesn't change. It is you who gets to decide if you want to cancel the life insurance, not them. The choice to cancel it in your hands, not the insurance company, and you own the policy.
That's a big deal, because as long as you hold up your end of the bargain, which is paying that premium as scheduled, then like I said earlier, it's a unilateral contract, which means the company is on the hook. They cannot cancel you or decrease that coverage. Arif, I want to also talk about, we didn't talk about this earlier, but if you have a term policy coming toward the end of that level term period, meaning you bought a 10-year or a 15-year or 20 or even 30-year policy, what happens at the end of that term? It doesn't just go away automatically, does it? There's an increase in cost, isn't there?
Yeah. If you have a 20-year life insurance policy, that just means the coverage does not decrease for 20 years and the cost does not increase for 20 years. So that's what you're buying, is the guarantee, at least the ones that we offer. The guarantee is for that period of time, a 10-year, 20-year, 30-year, whatever the time is. But here's what happens at the end of that time. At the end of that time, you end up coming up with a solution that says, I need to keep this policy for a much longer period of time. No problem. The company raises the rates. Now, when they raise the rates and they're saying, hey, you were paying $50 a month. Now you're going to have to pay, hold on to your horses here. Now you may have to pay $400 a month. I mean, it can increase substantially. So what do a lot of people do? Or at least some. Some people will go out and they'll shop the market and they'll sell their life insurance policy. That means they say, listen, I have a $500,000 policy. If I die, my family gets $500,000. But the cost is going to increase soon and I don't need it. I'm going to see if somebody else wants to buy it, another company or an individual. People do that. When they do that, you might receive, if it's $500,000, maybe you receive $75,000 in cash. So they go, here's $75,000 in cash. The company buys the $500,000 in life insurance. They are now the owner.
And they pay the premiums.
They pay the premiums year by year. What they usually require is once a year you have to sign an affidavit. Hey, I'm still alive. Hey, I'm still alive.
Right.
So, they'll keep checking in and making sure that you're alive during this period of time. They're still making the payments. When do they get the $500,000? After you die.
That's right. And if there's no market for that, or you don't know anybody or have access to that type of a scenario where you can sell it, you can, in many cases, and we haven't seen one yet where you weren't able to with a term policy, is to convert the policy. Now, if you have a $500,000 policy and you say, well, gosh, my kids are out of college, my house is paid off, I need maybe only $100,000 or $200,000, you can take whatever number you'd like and convert that to a permanent plan in most cases. You're going to want to check with your policy provisions, check with your insurance agent, the company that's insuring you. But in most cases, we've seen where you can take a part of that, if not all, and take that with you for the rest of your life.
If you're reasonably healthy, consider buying life insurance on your own, not just through the company you work for. If it's a benefit from the company you work for, that means they can cancel it. If they can give it to you, they can take it away. Especially as companies are trying to tighten and rules are changing, they may end up saying, listen, we're no longer going to subsidize your work life insurance. Or if as you hit certain ages, it increases in price every 5 years, every 10 years, it starts to increase. And if you get laid off or you quit or you're fired or you move to another job, you don't get to take it with you unless you have to spend lots more money. And sometimes they don't let you take it at all, because you've hit past age 65 or whatever the age. So use work as a supplement, but don't consider that as your primary source of income replacement for you and your family. Look, life insurance is a great thing. Use it for what it's worth. Don't consider it to be something that it isn't. It isn't going to be the end-all be-all for everybody, but it can be a supplement for you. Thanks for listening. I'm Arif Halaby. That's Jeff Gerard on your place for news, talk, and information, AM 1220 KHTS.